Welcome to the debate. Every single day, retail investors are willingly lighting about $350,000 on fire.
Yeah, well, or at least that's what the harshest critics of modern market structure will tell you, right?
Right, exactly. But, what if that money isn't actually just being lost in a vacuum? What if it is simply the cost of admission to basically the most precise, highly responsive financial tool that we've ever created?
I mean, I think calling it a precise tool really obscures the reality of what actually happens when you give everyday retail traders access to instruments with this level of embedded leverage and rapid decay. The sheer velocity of the capital destruction we are seeing today is just unprecedented.
Well, let's set the stage here. We are talking today about the absolute explosion of 0 days to expiration, or 0 DTE options. And to really understand the scale of this, you just have to look at the latest numbers from 2025 and early 2026.
The volume numbers are staggering.
Oh, they are insane. We just saw 15.2 billion options contracts traded in the US in a single year. That is a 26% year-over-year growth. We are hitting average daily volumes of over 60 million contracts.
Right, and peak days hit 70 million.
Yeah, exactly. And the notional value? $4 trillion in notional value is changing hands every single day. And the primary engine behind this massive structural shift is the 0 DTE market. These same-day expiring contracts now make up nearly 59% of all S&P 500 option volume.
And, the most critical piece of that data is who is actually driving it. Retail traders now account for 50 to 60% of that 0 DTE volume. So they aren't just participating on the margins anymore. I mean, retail flow is a structural pillar of the most volatile segment of the derivatives market.
Which sets up our core disagreement for today perfectly. My position is that 0 DTE options offer unparalleled strategic flexibility. They offer price-improved liquidity that effectively empowers sophisticated retail investors to position themselves with a precision that was previously reserved only for major institutions.
And I will argue the opposite. The structural realities of 0 DTEs, and specifically I mean the extreme time decay and insurmountable transaction costs, make them fundamentally detrimental to retail wealth. They effectively function as a lottery ticket that systematically drains capital while simultaneously introducing severe systemic negative gamma risks into the broader market.
Okay, so let's start with the market microstructure, because you really can't understand this 0 DTE explosion without looking at the actual plumbing, of how these trades are executed. The narrative is always that Wall Street is just preying on retail, but the exchanges have actually actively optimized the architecture to benefit the retail trader.
Are you talking about the routing systems?
Yeah, take the CBOE's Automated Price Improvement Mechanism, or AIM.
Right, the electronic auction system?
Exactly. Market makers actually prefer retail flow because it's dispersed, It is not a massive, highly directional, toxic block trade from some hedge fund that is going to just run them over.
Sure, it's easier to warehouse.
Right. Because this flow is easier to warehouse and hedge, AIM forces market makers into a 100 millisecond competitive electronic auction just for those retail orders. And the execution data shows this actually works. Retail traders are paying roughly a 6.0% effective spread for ODTE calls. Non-retail, institutional flow, they're paying 12.5%.
So retail gets a discount on the spread.
Exactly. The market structure is actively giving retail a pricing advantage. This is what true democratization of liquidity actually looks like.
Okay, but you are basically describing a highly efficient pipe, while completely ignoring the toxic waste that's flowing through it. I mean, a 50% reduction in the bid-ask spread on a trade with a fundamentally negative expected value still results in a ruined portfolio.
But it's cheaper execution.
The execution might be marginally cheaper, yes, but the aggregate wealth destruction is staggering. Since the introduction of daily expirations, retail investors have accumulated over $125 million in pure losses on 0 DTEs. You mentioned earlier they're losing $350,000 a day. You can't honestly call a product an empowering financial tool when the empirical result is a relentless daily drain on its user base.
Look, you only get that aggregate loss figure if you lump in every single speculative, poorly executed trade from amateur Robinhood users. When you actually filter the data for complex, defined risk multi-leg strategies, things like iron condors or put and call spreads, the median trades actually generate positive returns.
But how much of the volume is that really?
It's enough to show the tool works. Retail traders are deploying these multi-leg structures to capture intraday volatility crushes without taking on a single second of overnight gap risk. They don't have to worry about a macroeconomic headline hitting at 3 a.m. and destroying their portfolio.
But the multi-leg flow is not the dominant retail behavior. That is the massive disconnect here. You are pointing to the theoretical ideal, while the hard data shows retail behavior has actively shifted away from those risk-defined spreads.
I wouldn't say they've shifted entirely away.
Over 60% of retail zero DTE volume, and specifically 74.2% of retail orders, are for single-leg, naked, directional bets. They aren't hedging. They are just buying straight puts and straight calls. And when you do that in a zero-day environment, you are running face first into the most aggressive theta decay curve in all of finance.
Well, let me challenge the framing of that decay, because we really need to talk about the underlying mechanics here. Using a zero DTE option is like strapping a top-fuel drag racing engine into a chassis.
Okay, I like that analogy.
Right? You don't use it to commute to work. You use it for a hyper-specific 10-second burst of acceleration. The sheer velocity of the option Greeks in these final hours is the feature. It's not a bug. Yes, theta is aggressive, but you are being mathematically compensated by massive gamma exposure.
Assuming the market actually moves.
If you get a directional move, yes. The non-linear acceleration of your options delta right at the money provides a return profile you simply cannot replicate with owning regular stock.
If you get the move. That is the fatal caveat right there. Let's look at what that drag racing engine actually does to the driver when the light just stays red. In a standard 30-day option, theta, the time decay, is a slow leak. You have time for the underlying asset to oscillate.
Right.
But in a zero DTE option, especially between 2 p.m. and 4 p.m., theta is an absolute cliff. The underlying S&P 500 doesn't even have to move against you. If it simply stalls for 30 minutes, the value of that single leg premium just evaporates.
Because, well, the extrinsic value collapses to zero at the bell. That's just the mechanics of expiration.
Exactly. If a retail trader executes a debit strategy on a zero DTE call, paying cash up front, the index has to make a massive, immediate directional leap just to outpace that theta cliff. The velocity you are praising is precisely what kills the trade. Single-leg puts are averaging mean losses of $16.30 per trade.
Sure, but those are single leg.
Single-leg calls are losing $20.70 per trade. The dragster runs out of fuel on the starting line 9 times out of 10.
Okay, I don't dispute the mechanics of the decay. We all know how theta works. But you are portraying the retail participant as completely blind to this reality, as if they're just stubbornly slamming the buy button no matter what. The microstructure data suggests a highly adaptive ecosystem. Retail traders are actually modulating their exposure based on the intraday zero DTE VIX.
Are they? Because the daily loss rate strong implies a structural failure to adapt.
They actually are. Look at the 9:30 a.m. prints. The intraday VIX measures the specific implied volatility of options expiring that exact afternoon. When that metric spikes at the open, signaling that zero DTE premium is structurally very expensive, we see retail order flow dynamically shift.
Shift how exactly?
They adjust their strikes, they pull back on outright buying, or they pivot to credit strategies to actually harvest that elevated premium themselves. They are reading the dashboard of the dragster. And because we have 14 million zero DTE contracts trading daily, we have $36.8 billion in daily premium flow, providing absolutely unprecedented price discovery. This depth of liquidity benefits everyone in the ecosystem.
I want to focus on that liquidity, actually, because $4 trillion in daily notional volume is not just a benign pool of water. It has a massive gravitational pull. Every time retail buys those 14 million contracts, someone has to take the other side of that trade.
The market makers?
Yes, the market makers. And the data consistently shows retail is net long these options. They buy more than they sell.
This forces the market makers, the entities providing that liquidity you praise, into a massive continuous net short position. Their negative order imbalances are regularly dipping below -1%.
Right. But market makers warehouse risk. That is their entire function in the market. They aren't taking a directional bet. They are delta hedging their books.
They are trying to delta hedge, absolutely. But the extreme gamma of zero DTEs makes that hedge violently unstable. Let's break this down without oversimplifying it too much. When a market maker is net short zero DTE puts, they have immense negative gamma exposure. If the market begins to sell off, the delta of those out-of-the-money puts accelerates toward -1 at breakneck speed.
Which, mechanically, forces the market maker's overall book to become rapidly net long delta.
Precisely. To remain delta neutral, the market maker must aggressively sell the underlying S&P 500 futures. Now put this into a real-world scenario. Let's say it's 1:30 p.m. The market drops 50 basis points on some macro headline. Retail traders pile into puts to chase the momentum.
Standard behavior.
Right. Market makers sell them those puts, absorbing the negative gamma, and they immediately short the futures to hedge. Their shorting pushes the index down further. The index dropping causes the puts to go deeper in the money. The negative gamma expands, and the market makers are mathematically forced to short even more futures just to stay neutral.
You're describing a mechanical feedback loop.
It is a systemic accelerant. What should have been a standard intraday mean reversion becomes a severe, disorderly route. The tail is aggressively wagging the dog here. The underlying index is being pushed around by the hedging requirements of zero-day derivative expiration. This isn't just a retail wealth problem anymore. It is a structural fragility injected directly into the broader market.
I hear the theoretical argument for that negative gamma feedback loop. I really do. But market makers are not caught off guard by this. We are talking about highly sophisticated quantitative desks deploying algorithmic hedging that dynamically prices that exact jump risk into the premium they charge. They elevate implied volatility to compensate for the cost of maintaining that rapid delta hedge.
They do, but it still moves the market.
But I want to challenge your core premise here, that the retail side is purely a wealth-destroying lottery. If the structure is as fatally flawed as you claim, how do you account for the right side of the distribution curve?
You mean the lucky ones?
The successful ones. The source data explicitly shows that the top 5% of retail single-leg zero DTE trades generate returns exceeding 178% of their posted margin. Does that not demonstrate that engaged participants, those who successfully identify intraday momentum or correctly time a volatility crush, are utilizing these instruments exactly as intended?
I mean, pointing to a 95th percentile outcome to validate a trading strategy is the literal definition of survivorship bias. And frankly, it perfectly highlights the lottery mechanics at play here. Yes, 5% of the time, the rapid gamma expansion you mentioned earlier triggers a massive asymmetric payout.
A huge payout.
But look at the left side of that exact same curve. Over 25% of all retail single-leg zero DTE trades expire entirely worthless. A quarter of the time, the capital is just vaporized.
But that is the precise advantage of purchasing options. It is a defined risk instrument. Your downside is strictly capped to the premium paid. You cannot lose more than you put on the table, unlike, say, shorting futures, where your risk is theoretically infinite.
Okay, but a capped downside on a per-trade basis does not protect you from the aggregate bleed of a negative expected value system. And this brings us to the ultimate friction in this whole debate, transaction costs. Even with the SIBO's aim price improvements you touted earlier, the friction is just insurmountable for the retail buyer. Roughly 60% of the daily retail losses in zero DTE options are driven entirely by transaction costs.
You're referring to the bid-ask spread and the routing fees, mostly.
Yes, exactly. When you combine the spread with the sheer velocity of the theta decay, the mathematical hurdle to achieve profitability is massive. A retail trader has to perfectly predict the direction of the underlying, perfectly time the execution, and get a move violent enough to overcome both the premium decay and the spread. They are fighting the market, they are fighting the clock, and they're fighting the structural friction of the exchange itself. In that environment, the house always wins.
Well, that friction exists in any high-frequency short-duration strategy, but the fact that executing a precise strategy is difficult does not mean the tool itself lacks immense value. I look at this landscape and I see a triumph of financial engineering. We have a derivatives market handling $4 trillion in daily notional volume. That provides a depth of liquidity that was literally unimaginable a decade ago.
It's liquid, I'll give you that. Highly liquid. And zero DTEs give traders absolute immunity from overnight gap risk. They offer a level of tactical agility to hedge intraday exposure instantaneously. The fact that a subset of retail treats them as highly speculative, single-leg directional bets, that does not negate the intrinsic utility of the market structure itself.
But the utility cannot be divorced from the empirical reality of how the instrument is actually used. When over 50% of zero-day volume is retail and 75% of all retail S&P 500 options trades are concentrated in zero-day expirations, and the vast majority of those are single-leg lotteries, we have to look at the net impact.
Right.
Rapid time decay and transaction costs that consume 60% of potential profits guarantee a structural wealth transfer from retail to market makers. And by forcing those market makers into continuous negative gamma positions, we have introduced a latent fragility into intraday price discovery. It is an innovation that optimizes capital extraction, not market efficiency.
We clearly diverge on the net societal value of this volume, but there is a profound convergence in how we view the mechanics themselves. We both recognize that zero DTEs are entirely unforgiving. They demand a granular, almost institutional level understanding of how the Greeks behave under extreme time compression.
Completely agreed.
If a participant does not understand how an out-of-the-money delta accelerates nonlinearly in the final 2 hours, or how the collapse of extrinsic value acts as a literal cliff, the capital destruction is absolute.
Yeah, the velocity of these mechanics strips away any margin for error whatsoever. We just fundamentally disagree on whether the theoretical existence of a perfectly timed, risk-defined spread justifies a multi-billion-dollar ecosystem where the median reality is persistent daily losses.
It definitely forces us to confront what democratization in finance actually means today. The gates have been removed, the liquidity is unprecedented, and the instruments are sharper than ever. Whether that represents true financial empowerment or just a highly efficient mechanism for capital extraction is something every trader has to decide when they look at the option chain tomorrow morning. Thank you for joining us on The Debate.
If you found this video valuable, hit the subscribe button and join us for more exciting financial analysis. Thank you very much.